What's hot and what's not for real estate investors in Kentucky. Elissa Withrow from Keller Williams Louisville East exposes the raw numbers, risky trends, and hidden opportunities you can't ignore. I'm Milton.
And I'm Hampton.
And we want to welcome you to the Investor Tribe podcast.
Late night grind, got the cash in the flow. Flipping these dreams with the portfolio grow. Brick by brick, stacking wealth in the zone. Investor Tribe, obs where the hustle is home.
Today's show is brought to you by us. You can become a member at invtribe.com. We are everywhere on socials at invtribe. And season 2 is coming. 2 episodes a week on Monday and Thursday at 9 o'clock. That will begin on January 1st. All right. Well, welcome back, Elissa. For those who live under a rock, she's a market leader, guiding agents and investors through today's changing market. She's a market strategist, investor-friendly advocate, and leader of one of Kentucky's largest Keller Williams offices. She's also a friend of the Investor Tribe podcast, so we're very glad to have Elissa Withrow here with us today.
Yes, and we are vice presidents of her fan club.
I'll take that. I like that.
We're in the leadership of the fan club. Not quite at the top, but, I'm sure there's a whole bunch of people that's ahead of us, but we're super fans of you. Thank you for coming.
Well, I appreciate being here and I'm excited for the conversation. Here we go.
Excellent. Right. Excellent. And so it seems like the market at this point is a dynamic one. It's one where I've heard it described by Scott Piniella as you have to win the beauty contest or you will have a price war. So if you win the beauty contest, the price war is for your property amongst the buyers. If you lose the beauty contest, then the price war is on your property. What say you?
Well, that's another way of saying that we are in a competitive market where it's going to take skills and intentionality to properly sell a home for market value. And what that means is it's always been important to properly merchandise and properly price a home. But given the current challenges that we're up against, we have to next level that approach when we're listing properties. It's got to be so compelling the way that it looks, the way that it is merchandise. The beauty contest is what you're referring to, that when your buyers are walking into the property, they are now simply confirming their love for it so that they will then fight for the compelling offer. Whereas if you are not winning the beauty contest in any way, shape, or form, you are going to sit on market. You're going to create doubt in the buyer's eyes, and they're going to feel like they're getting their win by really chipping away at your price, which means wrecking your equity.
So we talked about the beauty contest. I'm kind of a numbers guy. Interest rates. You hear people concerned about where are they going to go. How does that impact the home sales? People buying and selling, or people holding on to their homes because of the interest rates? Are they letting go of them, or does it really not have much impact on everything?
Well, the answer is yes and no. And I know that is the worst answer for a really great question, because what we do know is that people will always buy and sell because they have to, meaning there is a base number of homes that will transact in the United States because people will not stop getting married, getting divorced, having change in family situations, diplomas, degrees, diapers, diamonds. We call those the Ds that get people to move. That subset of people have to make decisions no matter what the market conditions are. And
where would you place that number? Sorry, excuse me. Where would you place that number? I've heard it somewhere between 3.5 to 3.7 million dollars. 3.7 million units as a baseline for that activity.
Well, the good news is that baseline is actually a little bit higher. It's closer to 4 million, and that's homes sold nationwide. And right now, if you're to snapshot us as July 2025, we're sitting at 3.8, which is interesting because there's some suggestion and some forecasting that we're going to land above 4, maybe 4.1, potentially 4.2. And for that to happen, we're going to have a shift in one of two things. It's going to have to be jobs or interest rates. The government will make that decision. We don't know what that'll be.
Okay. What about what are the days on the market and the sales data revealing, and what story is that? What story are you getting from that?
Well, the days on market's on a steady rise. Here in Louisville, days on market, you can read anywhere between 35 and 45 when you're at a county look, a really high look. There's still some neighborhoods that are moving in under 20 days. So you always have to look at your days on market as a super hyper local stat. But here's the story that it's telling. The days on market are rising. which goes back to your question, Hampton, about some caution in the market. We're sensing less urgency. Buyers are taking more time to decide. They are being more negotiable, and sellers are, there is some trepidation, understandably, about getting off that fence, because while the percentage of people with a very low interest rate under 4 is shrinking by the day, that's still a big decision to make. You have to have a need to sell a home to unlock those golden handcuffs of a sub 4 interest rate.
Get out of the rat race and learn how to earn passive income with the Investor Tribe podcast. And for those of you out there that have those low interest rates, I know we've talked about it a little bit, and it, we would strongly urge you to consider to become a landlord. If you've got a very, very low interest rate and you can afford to keep that property and buy something new, there's a lot of accidental landlords that move or they get married, they join households, and they've got their original house and it couldn't sell, and it was easier to rent than to sell it sometimes, or they want to keep it for sentimental reasons. But that's how a lot of wealth is built, is just owning properties, buying and holding, letting the tenants pay down your debt if there is any debt, and you just ride that appreciation wave over time on the way up. But what do you have any advice to anyone that's considering whether to keep a home or keep that interest rate, or because those low interest rate, the below 4s and 3s it's like gold. You're going to save a fortune over the life of that loan.
Undoubtedly. And it is such a massive opportunity for the right person. And so the question becomes, who's the right candidate to hold on to their existing property, maximize the value of that low interest rate, and then purchase what they want or need on the other side? And please keep in mind, I'm going to take a very broad stroke. Everybody has a case-to-case basis, and you need someone who really has the skill set to understand the numbers and the cost and the future casting of that to make the best decision for you. But consider it this way. You have home A that you own right now. And if you're like most Americans, you have 50% or more equity in that home. We had an unprecedented equity build over the past 4 years or so in COVID, which, if you play it to your favor, could be massive in your wealth building opportunity. So you have an equity position that's favorable in the property that you own with a low interest rate. You bring in a tenant that is well vetted, who will take care of your home, who will pay on time. They're paying down your mortgage, and you're going to have a potential cash flow that then you can apply to the next property that will help offset that new monthly payment should you take on another mortgage. Now, the missing piece in that is that you do need to have the proper down payment to put you in a healthy equity position on the next property. That choice is for you as far as where that risk lies. But when the numbers work in your favor, you could look at 5 and 10 years from now and have home A paid off, home B paid into, and you had someone else helping you do it. It's a beautiful thing. I love investment properties.
So it's really interesting that you share that, because I have 1 point and 1 question. Mm-hmm. What percentage of homes have that 50% equity?
Right now, it's about half of America or more, and it's changing by the day.
So half of the homes in America have over 50% equity in their homes. I often tell people that their first home is their first investment property.
Yes.
So it's very wise how you allocate that capital, what type of store of value you want your home to be. Mm-hmm. Are you going to use it to go into a better situation? Are you going to use that home to generate income for you?
Right.
And so can you speak to the strongest areas where you're seeing the best opportunities for investors?
Absolutely. Well, statistically speaking, there's a pocket in southern Jefferson County, south, and even a bit west in Jefferson County, because the pricing is still so favorable for there to be a margin. Margin is one thing for investors, but the other one is affordability for the investors themselves. If you're paying rent, there's a ceiling on being able to attract the right renter that can step into the payment that's going to make sense for your investment. So that part of Jefferson County is one of them. But there is a massive opportunity right now in southern Indiana. and some of our outlying counties. We're seeing Southern Indiana. There is a construction boom. If you've driven over there, there's lots of builders building homes in those, quote, lower price points. They're not building your custom huge designer homes. They're building what they can build to get someone in at the lowest price from affordability standpoint. When you get out into Spencer counties and Shelby counties, we're seeing more multifamily opportunities because the margin is there. The cost of land is a little bit better, so the cost of real estate seems to be a little bit lower, and that's a massive attractor for investors to be able to find that cash flow.
Yep. Cash flow is, you'll hear a lot of investors say cash is king or cash flow is king. Have you noticed any shift? I know you mentioned some markets around Louisville, and I know a few investors they're branching out because there's been a lot of a lot of competition. There's markets that are untapped, and you throw a rock anywhere in Louisville, there's a bunch of investors trying to find deals, and used to be many investors wouldn't cross the river, wouldn't go outside the county, but now more and more of them are doing that to find those deals. But and also we've got out-of-state investors that are coming into town.
Yes.
So have you seen a shift between local versus out-of-state investor activity in the region? I know the out-of-state sometimes it ebbs and flows, but what's that currently looking like?
It ebbs and flows. And for those who don't understand at home, there was a substantial spike in out-of-state investors. Very, very large scale investors that were coming into cities all over the Midwest, and Louisville was no exception. Those large scale investors are definitely slowing down. However, we still have a large representative of out of state investors of smaller scales that are coming into the area because our cost of living is attractive for the investors who are going to rent in those homes, and our overall home prices are not only a little bit lower, we're just less volatile. It's a safer play. It's a lower risk play as opposed to an investor looking at some of these higher risk cities like Atlanta or Austin, Texas, or Phoenix, Arizona, Orlando, Florida. We're just a safer play comparatively speaking.
Managing real estate can be complicated. Get one thing off your plate and contact our friends at Liberty Mutual for great rates. Click the link below or call 1-800-266-0644 and mention Milton Ali, KY 444-689 for your free quote today.
All right. Well, kind of getting back into it, we've learned quite a bit about the local market and some of the national trends. What would you, to kind of recap, what would you say, how can you paint a picture of the current investor market, conditions in the Louisville area today?
The current picture is investors, keep your eyes on the southern aspects of Jefferson County. Be open to crossing the river because there is a wealth of opportunity. There's a boom of development out there. And then keep your mind for some more rural counties like Spencer County, Shelby County, and multifamily. If that's your direction, look at those pockets because there's definitely some margins and opportunity to gain some wealth.
Okay. And can you help us zoom out a little bit to give us more of a macro understanding of what's going on? Because there is a lot of information out there that's speaking to the national market, and we have viewers from all over. So shout out to California, shout out to Arizona, shout out to Texas.
Wherever you are.
Yes. Thank you for tuning in. And so can you help our members that are all over?
Absolutely. Speaking to the national level real estate market, we look at the big economic factors that impact the direction and decision making of our buyers and sellers. So obviously interest rates is up at the top, but interest rates are not the only impact to the decisions and the directions that people go. Now, interest rates right now are 6, 7. Am I allowed to do that?
You are.
I've got an 8th grader. I can't get away from it, right? But in all seriousness, they really are. That is still a perspective of an elevated interest rate because it's very different than the rates that we've lived in for the past few years. And here's what we are led to know as truth. There's nothing that's suggesting that those rates are going to dip substantially. Meaning, if you are prepared to make an investment in real estate, the time to wait is not now. The cost of money is the cost of money if you're going down more of those traditional products. Now, separately in the conversation, we can talk about different investment strategies, especially for investors that get you out of that rate conversation in some capacity. That being said, rates are elevated and normalizing with a potential for a slow and slight shakedown as we go through the next business quarters. But barring anything outside of what we know today, there's no suggestion that there's going to be a dramatic shift down. So don't wait because of the rate.
Yet, aren't we below the trend line? From a historical standpoint, there's perception and then there is the real number.
It depends on how far back you look, because if you include the late 80s and early 90s of interest rates pushing 17, 18%, then 6 and 7 is arguably below the trend line. However, if we start to look at the data that was recorded into the 90s and moving forward, and some would argue that that's a pretty responsible look back, that market norm is right about 6. So we're kind of living in typical normal times right now. And I think that that's a healthy thing to think about, because everybody wants to make sure that they're making a smart investment. No one wants to make a silly or destructive investment. And if it's around the rate, we can knock that domino over. We're good to go. We have a normal, typical, healthy interest rate. So the rates are there. The other things that we're looking at are inventory, days on market, home sales. So let's unpack those a little bit, if that's okay with you. So let's start let's start with the cost of homes on the traditional market. Okay. They are still on the rise, but they're decelerating. We're now only about 7 or 8% above the 3 to 4% appreciation trend line. Here's what that means. Real estate, no matter the market, no matter the time, has historically appreciated 3 to 4% year over year. Right? So if you're going to buy a piece of real estate, investment, or for your primary purposes, it's always a good time to buy unless you're thinking about selling in the next 6 or 12 months. Right?
So that goes back to something you said is you know about the waiting, to buy real estate for the interest rates. If you feel they're a little high, you can wait for them to come down. Mm-hmm. I'd like to tell people, don't wait to buy real estate.
No.
Buy real estate and wait. Time is your friend. The appreciation, and what you're mentioning is you're probably getting to the appreciation factor and the tax deductions, and then some of the cash flow if it's an investment property. But I didn't mean to interrupt. We're getting show notes, and our producer, you need to say that. Get in there. This is good stuff. This is good stuff. So
it's so true though, because we all are, myself included, we are so attracted to the shiny baubles and the get rich quicks. I mean, if you're not attracted to that, I wonder if you're a human being. But we have to be very discerning in that, especially in the investment world, because we can be sold an unrealistic bill, if you will, in this get rich quick scheme. If you're getting rich quick in a lot of real estate opportunities, I think that you need to exercise a lot of caution, and you need to be very, very educated in your decision, because for the majority of us, it is buy it and wait. Don't wait to buy it. In other words, if you ask a lot of real estate investors when they wish they would have bought something, they would have said 20 years ago. And they would have also just wished that they would have never sold that first property, because every time we look back, the 3 to 4% appreciation trend line has always held to be true.
What's really interesting about that is that in my personal history, I purchased a home, my wife and I purchased a home in what we would consider to be the best time in human history to purchase a home. Mm-hmm. And that was in 2010. Uh-huh. During the economic crisis. And then we purchased another home at the second best time that we felt like was the second best time in history, which was during the pandemic. Yep. And so when you really think about those things, yes, we were fortunate enough to take advantage of those patterns, right? So all that being aside, there is still opportunity out there. So I think the perception is that if you don't buy during those periods of time of extreme stress and downturn, then you missed the boat.
100%.
Is that true?
Absolutely. You can't time the market, but you can. I think the best thing an investor can do is be prepared when the opportunity comes, because timing it is futile. It is impossible. In fact, when we look back and figure out when we bought and when we sold, odds are it was kind of luck and circumstance, fate, whatever, fill in the blank. But the reason that we did it is because we were prepared to take advantage of the opportunity, because there's always opportunity when you buy the right piece of property. Because let's go back to the appreciation trend line in home prices. There's a big fear, at least in our local community, and I can speak better to the local community right now. The national number still supports it, but definitely local. There's a huge fear that they shouldn't be buying right now because they're afraid that the price of homes is going to fall dramatically and they will be upside down, because a lot of us might still be nursing a scar of 2010, 2008, when that actually did happen. What we're seeing in our numbers today is that while the average price of the home is on the rise, it's not as steeply on the rise, but listen to what I said. It's decelerating. It's not going backwards. So there's nothing that's suggesting that you're going to end up underwater, especially if you buy smart. You should always go into your deal on the front end. Don't ever go into a real estate deal hoping that it will work out on the way out. We buy on the way in. Every single time. We
win when we buy.
And you hear a lot of people say that's when you make the money, is when you buy. You got to buy it. You got to buy it right. And it can be impossible to time the market, whether it's real estate market or stock market. Sometimes it's luck, or you can use some research and intuition. But, sometimes you do get lucky. Other times you're prepared. But it's also the time in the market, not necessarily timing the market. We just mentioned, if you can hold on to it for a long time. I have a lot of investors, friends that they're kicking themselves because they missed out on a house over $1,000 or $5,000.
Right.
Negotiation, or came down to the final, and they're saying, "Gosh, I could have the tenant pay that. That house is worth $200,000 more than it was when I would have bought it. So I shouldn't worry about the little things.
No.
I should have spent that extra bit of money to buy that house. It all would have been fine in time." And they came out great, whether, whenever they bought it, if they can hold on to it, as you mentioned, for more than 6 months, a year, several years, the longer the better. They're setting themselves up for success. So, and like I said, I always do tell people to buy real estate and wait. Don't wait and buy real estate. We know that it may seem like a complicated process. That's why we even started the Investor Tribe. I'd like to encourage you to go to invtribe.com and become a member. We have education, deals, community, and more. Ask your questions, get your answers. Check out our video library. Check out our forms library. Visit invtribe.com and start your journey to financial freedom.
And so we had Jessica Yu on the pod. Okay.
Yes.
So she's a tribe member. She's absolutely amazing. And she shares this same story about her buying a property, and when she had bought it, no, she didn't. She decided not to buy it. And literally about 18 months later, the market shifted, and she said she lost out on thousands of dollars. So sometimes we trip over a dollar to pick up a dime.
Yes.
And so what are your recommendations right now for the fourth quarter of 2025? If you're sitting across an investor, you sit across a lot of people every day. What is your advice at this point?
Well, before I give advice, I would have to understand at a very high level what their goals are, because investors invest for different reasons. Some are really attracted to the cash flow. Others are attracted to depreciation and appreciation over time. Is it a tax move? What's your product? Are you going single family? Are you going multifamily? There is such a myriad of decisions to make. So getting acutely aware of your goal and your why is important. I think too many investors miss that. If you don't know what your business plan is for investment, you do run the risk of making bigger mistakes. So that being said, if they have their goals set forth, I would simply advise that they have somebody with a set of strong negotiation skills, someone who understands the market, who has access to off-market properties and in a way that's appropriate, so that they can have every single opportunity set in front of them. Someone that can find those properties or help them in equipping them to find them themselves, and then to have somebody, an accountability person, that is going to run numbers and help them make a decision that is mathematical and not emotional going into the rest of the year. Because the truth is, there's tons of opportunity. There's still lots and lots of opportunity.
Yes. And we agree. Please follow the rules when you are accessing off-market properties. The Investor Tribe, we follow the rules. There are rules in the state of Kentucky. Please follow the rules of your state and your location on accessing property and the purchase and sale of any real estate.
But I also heard, importance of building a team or having an accountability partner, having a tribe around you to run numbers, to get questions answered, to maybe learn from their experiences, or whether they're horror stories or success stories. There's a bit of both in real estate. It's not all roses and rainbows. There's ugly houses with abandoned cats and stinky carpets. That was my week last week.
Sure.
But it should come out fine on the end. So those stinky carpets smell like money. That's what a lot of investors say.
Yeah,
they do. Yeah.
But it's just part of investing.
Well, there's a model that mitigates that risk. There's a model to follow, and you listen by people who have done it before you, pros like those in Investor Tribe. And when you listen and learn and you're willing to make a decision that has no emotion attached to it, odds are you're going to find more success in investing.
We love that. And so what we want to do is kind of bring it right back in before we close out. And we want you to kind of give us again a prediction. So last time,
where's that magic 8 ball?
Where's that magic? We need to find. We forgot to bring it this time, and so. But what we want to know from you is just what do you see the market in the next, I would say, 3 to 6 months? What do you see going on in the market? So, and we're going to have you back. So we just wanted to get some
as long as she gets it right. If she gets it right, she does it right.
She'll be wanting to come back if she gets it right. But if it's all off, then she won't answer our calls.
Right. Well, nobody predicts the future. I've gone through that before. It's my joke. But however, there are indicators, and you should always be looking historically and understand what is probably going to happen. I do that every single day. In fact, I'm teaching a class tomorrow to our agents on just that. And here's what's expected based on what we know and based on the historical data is that we have a slight rise in inventory. We still have, at least in the Louisville area markets, we still have a seller's market, meaning there are more buyers. There's still a significant demand. And the feds are talking about some rate reductions. Now, remember, the Fed's reduction is not a complete predictor of what the mortgage rate is going to do. That's really important to understand that. It's definitely an indicator, definitely a suggestion. And there are a lot of signs pointing towards that direction. So given the slow rise in inventory and the pent-up demand of the buyers, if we shake that rate down, even at what Elissa is calling, no one else is calling this, by the way, the psychological rate reduction to make people feel safer about moving forward in the cost of today's money, we're going to see more buyer transactions. We're going to see an interesting uptick in movement. In other words, real estate agents for so many years have been used to the seasonality of the real estate market, meaning it's low in January, it rises through the summer, it falls back with a little bump in October, and then it goes back down and it cycles again. Since COVID, and since all of these unprecedented rates and situations and economic conditions have happened, our seasonality is just not true anymore. So I don't think that we're going to see the downshift, and there's suggestion that we'll see an upshift. Now, that won't happen if the government looks at our current unemployment, because right now we have a stagnation in the economy, which is not a healthy situation to have.
Can you speak and define stagnation for our audience?
I absolutely will. We've got interest rates that are elevated, and we have jobs. Unemployment is rising. Okay. The government does not want the rates to be too high, and they want people to be working, and you can't fix both at the same time. So the government's going to have to figure out which lever they're going to pull. When they're both going in the direction that they are, that is a very big problem for our democracy. We have to sit back and wait to see what decision they're going to make. And if the rates float down, we're going to be selling more houses. If they don't, we've got a different situation by the end of the year.
Yes. And so we could continue talking to you for the next few hours.
Yeah.
And we might do that. We might just have a podcast where you hang out with us for a while just to kind of unpack and unwrap a few things. And so what we want to do is thank you so much for coming by with us again. And we love to have the chats with you, and we know you'll be back.
Well, absolutely.
And so, yes, we're definitely grateful because Elissa Withrow is going to be a regular contributor on the Investor Tribe podcast. And we're so excited, and we're so glad that you accepted that, and that we're going to have you back really soon.
I'd love to.
We are. We're going to do it. I know we're talking about doing an agent special You know, talking about the
Yes.
real estate
Yes.
agents and
We're gonna
realtors
have-
and
yes.
all that you guys go through.
And that'll be for members only.
Yes, well, they're showing houses, phone calls, running comps, you know, putting all your time, sweat, and effort into it. And that's something you talk about. Just got me thinking that we do want to mention this to agents out there and other realtors is the seasonality when you're working with investors. We don't care what season it is.
No.
It's buying season
That's
or
so
selling
true.
season if you're selling.
That's buying season.
So-
right.
so
There's only 2 seasons.
If you're a realtor or a real estate agent out there, consider working with investors because they're going to buy more houses on average than your individual homeowner. They're going to buy them repeatedly. They're going to sell some houses as well occasionally. And if you need training on how to, you know, build up your client list or meet and mingle with investors, jump on the tribe. You know, stay tuned. Look up our agent, our realtor appreciation web podcast that'll be coming up in a few weeks, but we got to get to see when that release date is.
Yes. And join the tribe at invtribe.com. And also you can take training like the Flip Savvy course is exclusively on the tribe website right now. We also have a lot of community, a lot of training and access where you can speak to investors and agents yourself. And so you can find us on all the social medias, but you can also find us at invtribe.com. That is invtribe.com. And I'm Milton Ali.
And I'm Hampton Scurlock.
And we'll catch you on the flip side of the Investor Tribe.
The Investor Tribe podcast is brought to you by the Investor Tribe, all rights reserved, featuring Hampton Scurlock and Milton Ali, executive producer, produced and distributed by Bespoke Marketing.